everybody who is here electronically on Zoom, as well, especially as the people there in person. A big open-armed hug for everybody there. I can tell you that I'm very especially excited about today's show. I'm a mortgage consultant, have been for over a decade, and I can tell you firsthand how difficult it is to buy a house with low credit scores. Hard to refinance. You're not going to get the best deal. Hard to take cash out of that to invest elsewhere. Heck, sometimes if you want to rent a car, they need to double check your credit. If you want to get into some sort of a dish network, they'll check your credit. Or especially if you're trying to get a new job, a lot of times employers will check your credit. So this is especially going to be a great topic today. Now let me kick this off to Vivian Ho, who I can see is there in person, to introduce the rest of the show. Vivian, welcome.
Hi, everyone. Thank you so much for coming our Brunch and Learn today. I'm going to introduce myself. My name is Vivian Ho. I'm the mortgage consultant from Loan Depot. This is my sales manager, Ivan Choi. With his 21 years experience in mortgage lending, he will be here to answer all of your questions. Last but not least, we have a very special guest. She is the CEO of Get Credit Healthy. Her name is Elizabeth Karwowski. So we're going to start right now, okay? Okay, credit score is very important when clients want to apply for a mortgage or they want to refinance their house. So the credit score requirement will be vary from product to product. Some of them are more favorable toward a first-time home buyer who have very low down payment. The first program I want to introduce to you is the FHA loans. Minimum down payment for this program is only 3.5%. Not everybody have the 20% down payment. So this one is very special, only 3.5% down payment. The requirement for the credit score is 520. If someone will say, what if I don't even have 520, 580 credit score? Well, then for minimum credit score of 520, they have to put down at least 10%, okay? And the next one will be the VA loan. VA loan is for veteran. We all know that for the veteran, they are very special. To me, they are our hero. They put out their life to protect the country. So we are honored them with this special loan program is VA loans, and it's 0% down payment. The minimum credit score requirement for this program is 520. As the loan amount goes up, the credit score also goes up too. In this Bay Area, we have two most common loan program is conventional loan and jumbo loan. So next one I will talk is the conventional loan. Conventional loan, we have conforming and high balance. For conforming and high balance, the minimum credit score for this one is typically we say is 620, especially who doesn't have the 20% down payment, they put down less than 20%, and they will need to get the mortgage insurance. So minimum requirement for this is 620 in order to obtain a mortgage insurance. We don't really have a clean cut what is the minimum credit score for the conventional loan. However, if someone have very low credit score, that means this person either have late payment or they have very high usage of their credit card debt, and the automated system will not approve their loans. People might want to ask, what if people have what if some client they have a H1B visa, they are new to the country, they don't even have any credit history. So we can still do their loan as long as they have the credit score and one credit line, then we can do their loan. The next one is jumbo loan. For jumbo loan, we have different investor. Their guideline in terms of for reserve, credit score, and rental history are totally different, depend on which investor you go for. But typically, the minimum credit score requirement for jumbo loan is 680. The higher the credit score it is, you will get a better interest rate, like lower interest rate. Okay. I want to point out some general guideline for the jumbo loan. Usually, most of the lender, they will require you to have 3 trade lines, and 2 of the trade line have to have at least 2-year history. 1 trade line have to have a activity in the past 12 months. And if you have a late mortgage payment or rental late in the past of 30 days in the past 12 months, then you cannot get approved. So we have to be careful about that. For the foreign nationals, they can consult with HSBC, Citibank, and semi-hard money lender to get the jumbo loan. If you have any question, feel free to ask Ivan. Thank you. That's all.
Thank you, Vivian.
Thank you.
Jumbo loan, typically, depending on products, some of them, as long as you're $1 more than the conforming limit, which in the Bay Area is about 548,000, $1 more than that, we can stick into a jumbo product. And the rates right now, with the way the market's moving, the jumbo rates are actually better than conforming rates. So as long as you have the trade lines, credit scores, and reserves, we'll stick you in there and try to get you a better rate.
US.
Uh-huh.
If somebody lives in US, but he doesn't have a green card or is not a US citizen, but he works, would that be considered a foreign national? Can he get a foreign national?
Not most brokers won't do foreign nationals. That's why the couple banks that will deal with foreign nationals are Citibank and HSBC. As long as you have a visa of some sort, whether it's a tourist visa, you're buying a second home here, and you have enough income to qualify, they will get you a loan. Right? It's not that difficult. The rates are fairly similar to what the brokers can offer. No, you got to go. The borrower has to go directly to Citibank. Yeah, believe me, I would like to get those loans too. Yeah.
How would they qualify them for the loan? I mean, if they have, sorry, I mean, just how would they know what their credit score? I mean, they don't have any
There's no
score.
credit score requirement for foreigners per se, because I'm originally from Malaysia.
Okay.
And credit score is a very foreign thing. It's all about relationships with the banks.
Correct.
So from what I know, like HSBC and Citibank, if you go directly to them, you have to have some sort of relationship with them also. They'll either make you open an account to have enough money in there to loan you money. In terms of qualifying, they want to see your tax return from your country of origin.
So because these banks are international, they have to have an account overseas for them to qualify them?
They might make you open an account here locally and put $100,000 in there.
And that applies like for students, for like, traders coming in, or any of that sort.
That's true.
Now, for qualifying, if somebody buys a home in here and they have another property overseas, how much of that would impact, and is there need for proof of that?
They also take that into account. They have their portfolio where they also look at how much money you have in the bank total. They don't just look at your income per se. If you have enough money to cover all the mortgages, they'll lend you money too. Yeah.
But does it have to be documented? It
has to be documented.
It has to be documented. Okay. Now, these things like these over here is different than overseas.
Yes.
Because some people could say, this is my house, and they build it. There's no license. There's no documentation. It's their father's property, and they have a house in there. What kind of proof do they need internationally to prove that this property is documented? Because some countries do that without any registration, like, city laws or any kind of those things.
Because we deal with a lot of Indian nationals and trying to get loans here, and every time we ask for documentation, it's very difficult because depending on the municipal, all the documents doesn't correlate. They don't read properly, so it's kind of hard to document. But you still have to show some sort of documentation, and I don't know the exact details on that. So we really just have to go directly to them and ask them.
I mean, would an affidavit say that this is my property, I'm signing for it? Would that be qualified, or you
lawyers.
still need government local
You can have a
documentation?
lawyer give you an affidavit that you own the property. Yeah, some sort of official capacity to officiate your documents.
All right, thank you.
Yeah, welcome.
So thank you very much. And if you have more questions, we can talk after our next presenter. Next presenter will be the CEO of Get Credit Healthy. And let's welcome Elizabeth. She will bring us amazing informative presentation. Thank you.
Great. Thank you, Vivian. Good morning, everyone. Elizabeth Karwowski. We actually just rebranded to CredEvolv. I am going to pull up my screen here. Calling or zooming in from Chicago. So thank you again, Vivian, for inviting CredEvolv to be part of the group today. As Jonathan and Vivian mentioned, credit is an important topic. It affects everything of our lives, right? I like to say what we do and the information we provide is life-changing. Just a little bit about us and myself. I've been in the mortgage banking, lending / credit world for over 20 years. So I understand. Sorry, I don't know what that was, but so I understand quite a bit of the challenges people come across. CredEvolv itself, we are the technology that runs the nonprofit credit HUD agencies on our platform. So, you know, amongst our team, we've probably seen over 1 million credit reports running through our screens and our application. And at the end of the day, as I mentioned, credit is life-changing. I'm hoping that, and I talk fast sometimes, so if I am saying things, I invite you guys to put information in the chat so that you walk away with something. This is life-changing, and I hope that every single one of you today walk away with some information that you were not aware of. Credit is black and white in many ways. What affects it is the behavior of a consumer, right? Why does this impact me this way and it impacts my wife this way, right? Why does it impact another person? Same situations. Realistically, no situation is the same. No credit DNA is the same. Everyone has their own credit report for that reason. And so today, I am going to share with you. And if you do want more information about CredEvolv, you could go to CredEvolv.com and find out more about us. But as I mentioned, and as Vivian mentioned, I'm truly a credit expert, have all the necessary certifications, CRA, FICO certified, to really give you the information and guidance on credit. So what is today going to look like? Well, we're going to cover the 5 components of the credit score. Right. And really understanding these 5 components will help you understand why someone's credit is impacted today, right? What they did has impacted them today. And then also give you performance of each of these components so that you can help improve the results or at least give, again, the necessary guidance for your consumers. And as always, we welcome them to work with one of our credit coaches, HUD credit coaches within our platform. So looking at this, right, what is a credit score? How is it determined? How does it relate to me? So such important questions. And I know I can't see you guys, but I know this is a question I always get. Why is my credit different than the credit the lender pulls, right? I pulled it online. I pulled it from Credit Karma, Credit Sesame, all of these great educational tools. The reason is it depends on the model, right? A lot of these free tools right online, they are not the same model lenders use. At the same time, there's 3 bureaus, Experian, Equifax, TransUnion. Each one of them has separate models. So now this is where the confusion lies, right? How can you as a consumer actually know what you're getting involved with? Perfect example, I just went to get a car, right? A car FICO score is different than a mortgage FICO score. I know my score. I keep track of it, right? I'm in our coaching program, so I could see our actual FICO score on a monthly basis. It's a consumer-driven FICO score, so it doesn't negatively impact me. But my gosh, a new score was pulled, not the same one I have. And, understanding credit, I knew what I was getting myself into. I knew how to handle it. I knew what was the possibility, right? But many people do not, which becomes very frustrating. And as mentioned, when you're looking online, a lot of these free scoring models, it's called a Vantage score. Vantage score, I mean, that itself, I could talk about scoring models for an hour simply, but Vantage score is, it goes up to 900. FICO scores, the scores that lenders use, mortgage lenders, it only goes to 850. So right there is a 50 point difference, right? So what I'm discussing today really focuses on behavior, and it could be applied to any scoring model, but the percentages are slightly different. So today we're focusing on FICO scores that lenders use so that everyone is clear, because if someone says, well, I heard past delinquency is a slightly different percentage and how does this impact me? Just please understand that, again, if people are pulling different FICOs or pulling different scores, the first question we always ask, we train people on this. What is the scoring model you use? And people are like, huh? And then I say, go to the bottom of the page of where you're at. And hopefully you guys could do this right now, right? If you have your phone, I know I want you guys to pay attention because this is life-changing information. But at the same time, if at the end of this presentation, go to your phone, go to those credit scores that you get, and you'll see that it says, if it is a FICO score, it's not the scoring model, because for lenders, they use 2, 3, and 5, or 2, 4, and 5. And I have one of my associates that will assist if needed. Whereas FICO right now shows FICO 09, again, a different scoring model, right? But the key components is the behavior. We're going to talk about the 5 components of credit: past delinquencies, debt ratios, average age of a file, mixed credit, and inquiries. You guys might be like, all right, I think I understand, but you know what? Let me go into detail. Let me go into detail on every single one of these, because we want to ensure that you have a basic understanding. And when I say basic, it's really real life experience to help a consumer. But before I go into that, right, one thing I want to stress, and this is extremely important, when you're dealing with anyone that talks about credit, okay, as I mentioned, credit is no secret. Right? It's very black and white. When someone says I could remove something off one's credit report, don't worry about that. Don't pay for that. Worry. Okay. There is no such thing that you could just remove, because there is no magic involved. It is because the Fair Credit Reporting Act, the Fair Debt Collections Practices Act, all of these different rules and regulations that protect us as consumers, creditor must abide by, right? And so what we always stress when we talk to consumers and we coach our credit counseling agencies is that anything, everything, and anything on one's credit report has to report timely, be 100% verifiable, and be 100% accurate. Now, when things do fall off, it's because something is not verifiable or not accurate, and it's not reporting properly. But again, it's understanding, and it's having that understanding of how to look at a credit report to spot check that, to see, to ensure, and that's what we do, or our counseling agencies do. So why I stress this is because if someone says anything different, understand it's truly black and white. There's no magic behind it. There's just a lot of legwork. And at the end of the day, it's truly finding a solution for the consumer. So going into component number 1, the largest component, it's past delinquencies. As I said, this is 35% of your score, right? And so I pulled up, or I had one of my team member pull up and look at this. And if you're looking at a credit report, right? And just like Vivian mentioned, for jumbo, you cannot have a 30-day late in the last 12 months. Why is that so important for your credit, right? The lending guidelines, very separate from credit. Credit, why it's important, because anything that happens today or recently has truly a real negative impact on you. I've had people that have come to the program and said, Elizabeth, I have one collection. I make this amount of money. How is it possible that my credit dropped 75 points, right? And I like to say credit doesn't discriminate. It falls into a portal or a percent. 1 times 30 late is a past delinquency. It's very recent, has the most negative impact on you. So why collections or why late payments or anything that is pertaining to delinquencies, if it happens today or in the last 12 months, even 2 years, right, it will still have such a negative hit against you. And as you move on, right, credit negative delinquencies can stay on your report 7 years, up to 7 years, maybe even 10 if it's a bankruptcy, right? So that's where it has less and less of an impact. But I could stress again, if it's recent, past delinquencies have truly the most negative impact. That is why when people get so upset over a $100 collection bill and it shows on their credit report, they're really upset with every right. However, one thing I stress, this is for mortgage lenders. When you go to the newest FICO scoring model, when a collection shows up, it doesn't impact their score the same way it does for a mortgage lender FICO scoring model. So please remember, I am talking and I'm repeating myself, but this is so important because sometimes people leave the workshops that we do saying, I got it. And then they go and say, but wait, on this model, it's showing this way. What we're discussing specifically is for mortgage lending models, okay? And so here we are. If you look at my pie chart, 35% impacts you the greatest. What's the next thing, right? What's the next thing that impacts you 30%? It's the debt ratio. So if someone wants to raise their score as quickly as possible, the first thing we look at, and the first guidance I always say, do you have enough money to pay off your debt, right? Because if you do, then that can raise your score 30%, depending on, of course, where your credit limit is to your credit balance. Why is that important? Because if your credit limit is, let's say, $1,000 and you're using $900, yes, you will pay that down under 30% or down to even 0. You will see a huge impact in your credit. However, if you go from 1,000 or from 900 to 850, you're not going to, because anything over 30%, even 50% is looked upon as a credit risk, right? That you're over, your balance is high compared to your credit limit. So another quick way of helping and making life-changing experience, right? Especially if you're looking to have a consumer get into a home and they're getting a $400 or $300 or $1 million home. Credits, interest rates are based on credit score. And if they want the best credit score possible, this is a quick way of helping them if they have the capital to do so. And that again is 30%, right? And so here I'm just showing an example of revolving. They look at not only revolving, but installments. At this point, I always tell people don't focus too much on installments, really focus on the revolving, because that can be updated very quickly with the bureaus. And that usually is the easiest thing to help boost one's credit score. And here again, 30%. Moving on is the average age of a file. So we always have sometimes people that say, I've had too many credit cards. I shut down all of them, right? And you guys might be thinking, my gosh, I know I've done that. And you might have seen by doing so, your score dropped. And sometimes you think, well, why would my score drop if I didn't do anything wrong? I just shut down my credit cards because I had too many. I wasn't using them. Well, the average age of a file is actually 15% of your score. So all of a sudden, if you close down the one that was an 85 and kept the one that was a 95 and 99, you just shut down 10 years of your credit. On top of it, you also, if you have a high credit limit, because all of this is connected. If you think about it, it's a circle, right? So if you have a high credit limit and you're not using that card, that credit limit, which was part of the utilization, overall utilization, again, what we just talked about, the 30%, you close that down too. So what I always stress is before you close any account down, look at these key components. When did you open it? What is the credit limit? Will that impact your score? And if you're not sure, again, we welcome you to speak to one of our counseling agencies to actually think through this process, because 15% can go from a 740 to easily under a 720, right? So you're getting A+ credit down to, A credit, which again, for purposes of mortgages, is your interest rate. So these small transitions, one that an individual would think should not negatively impact you, most definitely impacts you. And it's so important to share in order to, with your consumers, in order to help them make sure their credit is working for them, not against them. So as mentioned, that's average age of a file, and that's 15%. So now we're going in, there's two more components. And I know I'm going over this pretty quickly. This is stuff that we do train quite a bit, and we encourage you guys to reach out. But the next thing we talk about is mix of credit, right? And this is another example. I like giving examples. I have people in their 50s and 60s that have 800+ credit scores. Then I have a 21-year-old, and those that are young and out of college, I appreciate the enthusiasm to get to an 850, but it's not that easy, right? Why? Well, as you know, average age of credit is number one, because FICO actually uses, when they're doing the simulation, they're using real data of other individuals that have similar profiles like you, right? But also the other component is a mix of credit history. Many times in your early 20s, you will not have that mix of credit credit similar to those in their 40s, 50s, 60s, 70s, right? You won't have a mortgage, revolving installments, and that is 10% of your credit. So having a mix of credit is a benefit to being part of a different pool, which then increases your opportunity of having a higher credit score. Now, sometimes it's just not possible, right? So this is an important component to understand, but reality is that sometimes it's simply not possible, and you still could be in the mid 700s without having a mortgage. But it's, again, understanding the three other components that we discussed so that you can have and build your credit. And then the last, and here it is, 10%. And the last component I wanted to quickly address before we go into some Q&As is inquiries. Inquiries is 10% of your score, right? So we always stress that, and you could see here on this one, it's showing TU inquiry and then 3 Equifax. When you see something like this, when we see something like this, we already know Experian, if everything else reports the same, Experian will have a higher credit score than TU and Equifax. And that's because it actually was pooled more, and inquiries has 10% of your score. So this is another key component. Not everything reports to all 3 bureaus. Not every creditor pools all 3 bureaus. Therefore, a score can differentiate between all 3 bureaus because of these factors. Here we know these creditors pooled mostly TransUnion, no one pooled Experian, and 3 pooled Equifax, right? So we know if inquiries are 10% of your score, automatically you will know TransUnion is more negatively impacted than any of the other 2 bureaus. So when you look at that, that's 10% of your score. So that's why I always stress, even when we went to the car dealer, I said, you're pulling 1 credit, right? Where are you taking me? What's going on? Talk to me about this, because if they submit it to 10 different creditors, which they like to do sometimes to get the best interest rate, it does negatively impact you. Not right away because there's a shopping period, but it does negatively impact you. Therefore, we always stress to be an educated borrower. Don't be afraid to ask these questions. The finance guy should, if he is knowledgeable or she is knowledgeable, They will inform you what they're going to do so that you could have a comfort, because again, inquiries does and can negatively impact you by 10%, depending on where they're pulling and by to what credit bureau. So with that, just a quick assessment, right? As we get to the end of this presentation and go into some of the Q&As. Past delinquencies, 35%, any of this that's recent, doesn't matter in what category you are, anything that's most recent will have a negative impact on you because recent activity affects you the most. But past delinquencies, lates, collections, charge-offs, any of that happens today, it's 35% of your score. You better believe you will see a very large drop. Debt ratios, if you could pay off certain debt and get under 30%, if not 30, 50% of that credit card, that's what we should focus on. That's where you should provide guidance to your consumer. Average age of a file, if someone does not have control of their credit, my gosh, I always like to say, let's get control of your finances and then worry about your credit. But at the same time, as they're getting control, it's great to understand how it will impact your credit score. At any point they need assistance, we have HUD counselors that can provide them. Mix of credit, again, the variety of different credit is beneficial. Sometimes it's not possible, but it is beneficial. And inquiries, understanding that it does have a negative impact if multiple creditors pull your credit score. So I have some Q&As, right? And I'm going to invite, I don't know if Katya is here, because I always like to make this interactive, or if anyone wants to come to the podium and ask any questions. But I'm going to talk. Katya, are you on the call?
I'm here, yes.
Oh, great. Perfect. As I mentioned, I invited one of my associates who too has seen thousands and thousands and is our vice president of training for all of our credit coaches. So I thought instead of me talking this whole time, I'd love to go over these questions with you. And then at the same time, see if there's any chat, any questions. Oh, we do have some questions.
We do, yeah.
Yes, phenomenal, great. So if we could maybe interact and leave the last 5 to 10 minutes pertaining to these questions. Does that work?
Awesome. Elizabeth, would you be able to stop sharing your screen, because then we can all see you in the room here?
Oh, great. Yes.
Perfect. So you are there. Do you want to start off with the questions on Zoom, and then we can go around to the questions that we have here live?
Sure, let's do that.
Perfect. So I can read them for everyone here who's not able to see. So the first question is, what about if client's credit card company closes the account for not using it for a long time? How does that affect them in score?
Great question. Katya, I invite you, and I'll take the next one.
Sure. So with regards to how it affects the credit, for credit score purposes, it is irrelevant if the account is closed by the credit grantor or by the consumer. It affects the credit the same. They will lose time with history. So it affects the average length of credit. All of the payment history that they have with that specific account won't be taken into consideration for their credit score. So we always advise consumers, make sure that you use your credit cards every couple of months, right? Some people just want to have lines of credit available and not use them, and just because the utilization is going to be impacted if they do use it, but we want to make sure that they use it every couple of months, make a payment so that there is some activity there, because the creditor is going to think this person doesn't want or doesn't need this line of credit, and it's just going to close it down.
How terrible. All right, how terrible. And that's the hardest part to have with the customer, but it's the truth. Thanks, Katya. It doesn't matter if they close it down or anyone else. The only thing is that it reports differently on the credit report, but the impact on the score is still pretty dramatic. So thank you.
And the next question we have from Zoom is, how much does a mortgage credit inquiry impact the scores?
Great. Mortgage credit inquiry, just like anyone else, falls into that 10%. So it's a 10% hit against, but there is a shopping period. That's why working with the same mortgage broker or banker or lender is important, that they could provide you that information.
Awesome, thank you. Does anyone in the room have any questions they would like to ask?
I do. I was wondering on a mortgage credit pull, you said for consumer, it affects it 10%. How many points does the score drop, you know, if they have multiple lenders pulling a report?
Yeah, Kathy, you want to start and then I'll finish?
We normally see about a 3 to 5 point decrease with every inquiry.
Got
And
it.
again,
Then we have, oh, sorry, Elizabeth, go
sorry,
for
that's
it.
okay. And Tina, there is that shopping period. They won't see it all impact them right away. So if they go from one to the next, however, after 45 days, they will have an impact. So it's important for a consumer to understand, be an educated borrower, right? If they know that they're at 640, talk to the lender, talk to Loan Depot and say, hey, I'm at 640, where do we stand? Feel comfortable, because once it's pooled, you know, and if they're going somewhere else to see if they could get better or can do the deal, right? I mean, they're just, they're not finding a solution to their problem. And that's what we stress across everyone. Let's find the solution before you go from broker to broker or banker to banker to banker. Let's find really what's going on so that you can feel confident going in and applying for that loan.
Awesome, and we have Michelle in at SCORE with a question.
Good morning. I have heard in the past from credit experts like you that a borrower could have like 3 credit pulls if it's from different lenders in a 30-day period, and it won't negatively affect the credit score. Is that still correct?
It is, and Katya, correct me, but if I recall, it's 45 days, as mentioned. And it doesn't, you know, they say that it should not impact, but from actually viewing reports, we do see more than a 3 to 5 hit, right? And so again, it could be a functionality of where they fall compared to others. Katya, I invite you.
I agree. Yeah, there's that shopping period, but again, we have seen where the credit scores are impacted real time.
And was it correct that it was every 3 to 5 points every pull? So from different lenders?
Correct. Yeah.
Thank
So
you.
again, and
Even in that 45-day period, it's going to hit it. Say they have 2 lenders, it's going to hit it 6 points.
it shouldn't hit it within the shopping period.
Okay.
Okay, it shouldn't hit it through the shopping period, but I would always suggest to the consumer, because credit moves so much, there's so much activity happening. And what we've seen, we do see that there is a negative impact. At the end of the day, after that shopping period, we have had people get very upset at their lender saying, why did you pull my report? What's going on? Because it's not a supplemental credit, it's an actual hard pull.
So I have a
Elizabeth, we have a
question.
question here in the room from Anita. So Anita, go for it.
So during the pandemic, a lot of self-employed businesses, meaning my scenario, there's no entity. It's not an LLC, it's not an LLP, it's not an S corp. It is a sole proprietor, took out either an EIDL loan or a PPP loan that has not been forgiven from the SBA. Those are not necessarily showing up on the credit report, but how is that affecting somebody's ability then to go out and get a loan to buy a house? And how does, is that affecting it at all, even though it's not showing on the credit report?
Yeah, that's a great question that I would guide the individual to talk to the mortgage broker or banker specifically, because for credit, even if it's a sole proprietor, it's still a business. And so there's business credit reports and then there's consumer credit reports. And for those, again, I would guide someone who is truly an SBA loan expert to talk through that situation. Because it's not applying to your credit. It's not reporting to your credit. They're not personally guaranteed So it's not, but from a business perspective and also from a personal financial getting a loan, I would really encourage the person to talk to Loan Depot, Vivian, or someone within their team to understand what are the guidelines.
So one question from Zoom for you is, what is your opinion on Credit Karma and similar resources?
I think if people go in knowing that it's education, it's a great tool, right? It's a great tool. But if they're going in to understand apples to apples of what a lender pulls, it becomes very confusing. Katya, I don't know if you have anything to add, because I know.
I agree. You have to take into consideration what you're looking at it for. I think it's great to see for context, to make sure your accounts are reporting. I know like Credit Karma does give you an alert, like if you have a new derogatory account, or I think it's great also if you're monitoring or think there's anything going on with your credit and identity theft, right? Because it'll trigger alerts for you to receive notifications if someone's trying to pull your credit. But if it's someone that has a thought process of, I want to purchase a home or I want to purchase a vehicle, let me look at my credit score there, then I don't recommend it.
Becomes very confusing because again, the scoring models are different.
Perfect. Do we have anyone on Zoom who would like to unmute themselves and ask a question? If so, go for it.
Yeah, I got a question right here. So if you have 3 or 4 lenders, pull your credit within a period of 1 week, is the effect the same as one, or is different?
At that period, it should be affected as one.
Gotcha. So if you shop with the different lenders, if you tell them, hey, pull your credit between this time and this time, so the effect is less than putting different time. Got you.
Yeah, it's a short period, but again, I always stress that the impact might not happen, and we know people don't close in 30 days. So, it's always to be a smart borrower.
I have a question. I had a client that had a collection account, as you mentioned earlier. It was only like $59. And when I did an analyzer, it shot their score like 75 points. It was huge. And so I said, call them and ask them to delete it. You're going to have to pay it. So they kind of tricked him into thinking they were going to delete it. They paid it. Can the collection agencies really delete a line item like that? And what is the protocol for that?
They can, and that's one of the Q&As that I had. They can delete it, right? There's nothing that says a creditor has to report certain things, right? The only thing that they have to abide by is that it is fair, accurate, and reporting, and it's verifiable, right? But if they decide not to report, they do not have to report. Many times what we have come across is that collection agencies would not report or update it because there is a cost, right? Every time they send information to the bureaus, they have to pay a fee. So we have seen that, and there is possibility that consumer can question it, but everything should be documented, and they need to go to the bureaus to question the accuracy of how it's being reported. Because as I mentioned, though they took the payment, they might have not updated the information. And this is a perfect example. They might have not updated the information, and therefore, if you challenge it in a proper format based on specific rules and regulations, they will remove it, but they don't remove it just because it has to be removed, right? Under the Fair Credit Reporting Act, the creditor did not follow these procedures. They took the money, didn't update it properly, and therefore it's removed. Does that answer your question?
Yeah, it does.
Great. And the same with late payments, right? We have seen many consumers, that come in and they're reporting me late. I wasn't late. There might have been some, the electronic transfer method that they use, something happened with their systems, right? It is truly understanding what rules and regulations protect you as a consumer to request the bureaus to update it properly, or going specifically to the creditor and getting that type of documentation. And that, I believe, Tina, it was your clients that, went, did the right thing, paid it, but they might have paid. And what we always like to say, are you paying debt that you really owe? Or are you paying a debt that added interest on top of interest on top of interest, which creditors cannot do, right? Collection agency, I'm sorry, not creditors, collection agencies. So that's always the start of validating the information before any action of payment is taking place.
So question, so wasn't any of that, they basically even discounted it because they had moved and the mail didn't get to them. Otherwise they would have paid it. And so would you recommend that they go to the bureau level and dispute it and say, hey, you know, we paid this, it was a misunderstanding, we moved, you never called us, we would have paid it, you said you were going to delete it if we paid it and you didn't, was that a fair dispute to them? That you think would work?
They really don't care about that because it's more emotional, unfortunately.
Okay.
If they had specifics that someone said it was reporting incorrectly and had the specifics, then I would say yes. Otherwise, they do have to go through a verification process.
Okay.
And it's painful, but the 75 points might be more painful. Right? So if they work with professionals, as mentioned, anyone that might need assistance, I do have my contact information, or you could reach us on CredEvolv.com and they could provide that guidance. Any other questions? Great questions. And hopefully this was beneficial to all. As mentioned, credit is, you know, as we say, it is a complex topic because of the different models, because of the third-party creditors that you're dealing with, the bureaus, the different bureaus, and how everything relates. But hopefully I have provided some basic general understanding that you can share with your consumers and your family and friends, so that, you know, some of the simple mistakes are no longer mistakes.
Yeah, Elizabeth, that was awesome. Thank you so much. Would you please drop your contact information into the Zoom chat? And then for those in the room, I'll make sure to pass that out to you as well.
Great. Absolutely.
Thank you so much. Thank you for everyone who attended today. As always, this session was recorded, so as soon as it's all done, we'll get it right up on the website and y'all will be able to go back through it. Elizabeth, I have a copy of your slides. If you are okay with it, I can share it with everyone who attended today, so they'll have your information and your slides as well.
Absolutely. I welcome everyone. As I mentioned, we are the platform that triggers the activity for HUD credit counseling agencies. So we like to say they have the heart. They want to provide this type of information. We have helped thousands of families change their life. And it's really a rewarding experience when you see testimonials come through on a daily basis saying, wow, I thought I would never get here, right? And so as I like to say, we are credit experts. We leave it to our mortgage partners to be mortgage experts and our real estate partners to really be the real estate experts. So hopefully, if you do have any technical questions from a credit perspective, we can be the experts for you. But if it is pertaining, as mentioned, to loans, I request that you talk to Vivian and her team members so that she could provide the right guidance, because the guidelines change all the time. And truly, they're the ones that are involved in that. So I appreciate everyone's time. Thank you so much for inviting us. And hopefully everyone did get some valuable information from today's presentation.
Absolutely. Thank you so much, Elizabeth. Now we're going to turn it back over to Jonathan.